one does not simply sell Gala. Or does it actually make sense to sell Gala sometimes? Does it make sense to take advantage of this massive volatility? The Gala token does occasionally crash quite a bit, right? 85% over here. At the beginning, more than 90%. Just recently, more than 70%. Could you potentially sell when the price is comparatively elevated and then rebuy back in again when the price has come down by that much? Can we potentially use mathematics in order to time this? I've prepared quite a few interesting charts. We've got quite nice simulations here of buying and selling according to different rules. So we are going to look at all of this. Let's stop with the fluff and let's jump right in. Hi, in this video we're going to discuss timing the Gala token market, timing the price, trying to not just hold all our way through, right? Even though Gala did appreciate quite a bit over the long term, right? We're trying not just to buy and hold, but we will look at various strategies to potentially take advantage of these massive swings over here. And so as so often on this channel, what we're going to do is we will run a simulation. We will look at how would it worked in the past if we bought and sold according to certain rules. We are going to use the simple moving average to determine that buying and selling. So the idea is we want to be in the market when the price is above the moving average. We want to be outside of the market when the price is below the moving average, right? So we are not enduring all of this negative momentum while we are in the market when prices rise. Now, when you follow such a strategy, the question is always, what duration of the moving average should you take, right? Should you take maybe the 20-day moving average? Should you take the 30-day? Should you take the 50-day? It's not that obvious. And the answer to this question is also different depending on what cryptocurrency you're looking at, because the volatility of each cryptocurrency is different, right? The risk inherent in different cryptocurrencies differs. And so without further ado, let's jump into the very first, very interesting finding here. So the idea is that you want to be outside of the market when we are below the moving averages. I have backtested the simple moving average. I've also backtested the exponential moving average. And last but not least, a combination of both a simple and an exponential moving average. That's the red line. So green, simple, yellow, exponential, red combination. And then in black over here, we see the buy and hold line, the HODL line. Now on the x-axis, we've got the duration of those moving averages all the way from 1 day. So if we just look at yesterday's price to 52 days. So a 52-day simple moving average, exponential or combination. Now here is a result we do not see often with cryptocurrencies. Every single backtest that I've run over here, and this is more than 150 backtests, right? I've tested all of those durations. These 150 simulations of trading, all of them underperformed just buying and holding, despite this incredible volatility in the Gala token. I found this very, very surprising because it is counterintuitive, right? It would be more intuitive to say if we are not in the market during those kind of times that we should actually be able to buy back in like 3 times the amount here, right? If we don't follow the price over here. But in aggregate, that's actually not working. Let's look at the result of the 44-day simple moving average. I like to use the simple moving average. For most of the trading simulations that I've run, the simple moving average actually tends to outperform the exponential one. Not necessarily here for Gala, right? For most of these points, the EMA is actually above the SMA, but that's definitely something specific to Gala. It's also very specific to Gala here that we see an underperformance to buying and holding for all of those data points. It's also very, very uncommon. We don't see this in Bitcoin. We don't see this in Ethereum, but in Gala, we do exactly see that. Now let's look at this. The 44-day simple moving average trading return. This is how it looks like. This is a simulation of starting with 10,000 US dollars. It would have risen all the way to 2 million if you just bought and held. So that's the white line. In green, we see the backtest result. So note how sometimes we are here outside of the market, right? So this line is completely flat. We are not following the price movements. We basically got bearish after we've seen already quite a bit of a price decline. Now, the problem with this chart here is it's on a linear scale. We want to see this on a logarithmic scale. So this and this is the exact same thing, just that we can see more of the price action here in the early days when looking at 10x changes rather than looking at 500,000 changes, right? So this can tell us a bit more of what's actually happening. We do avoid a bit of volatility, right? So this top to this bottom, it is more of a drawdown than what we get with selling whenever we fall below the simple moving average. But still, summing this all up, most of the time we are below buying and holding. So the end result here is lower. And what I find particularly interesting here is this is already the best of the simple moving averages, right? So, or one of the best at least. We are already kind of cherry picking what historically worked the best. The best simple moving average duration, it might slightly change over time, right? It has changed for Bitcoin. It has changed for Ethereum. Not by a lot, but it's not 100% stable. And so even though we already take the best simple moving average, we don't get a lot of encouraging results here. Now I've also done the same for the EMA. So for the exponential moving average, this is now the 51-day EMA. So that's this point over here. So same story, we are not outperforming. It doesn't really matter actually if you take the simple moving average or the exponential one, right? When we look at the comparison of both of those charts are very similar in their end result. Now I didn't stop here though. So what you might have noticed here, I've wrote that there is zero buffer. Now, what does zero buffer mean? Zero buffer is a protection against failed signals, or when we do have buffer, it's a protection against failed signals. So the idea is when we are in a sidewards trading range, we don't want to always buy in and out of the asset. So we would be buying over here, for example, right? We are above the moving average, and then we would be selling again over here. Note this backtest, the simulation, simply just looks at the day end prices. So at midnight UTC, we are only trading once per day. We are not going to trade in and out when we cross this moving average all the time. So there's two problems here. You do several bad trades when we are very close to the moving average, right? This repeats itself. So you're buying high, potentially selling lower again. That's one problem. The other problem is each time you execute such a trade, you pay fees. And for this simulation, I've used 0.1% fees. So that's the Binance trading fees. 0.1% for a buy, 0.1% for a sell. The idea of the buffer is to not trigger any of those signals unless we have come beyond a certain threshold. So we take a certain percentage difference from this moving average, and we would only buy whenever the price extends from that moving average by that buffer. So you wouldn't do any trades over here. We would only do a trade once we exit this buffer zone. The same is true for the other way around, right? We would only trade once we fall below the lower buffer. So this reduces the number of our trades. It should also reduce all of this noise over here, potentially improving the final result. Now the question is, what kind of a buffer should we take, right? Should we only take, say, 3% or so, just ignore these kind of wicks, or should we rather be more generous with this and take maybe 10%? So I've done a backtest on this with the 44-day simple moving average. So no buffer at all means 3,800% per annum, roughly, right? Which is underperforming the 7,000 buy and hold. Then for a lot of these buffer values, right, here at the x-axis, we've got the buffer. For a lot of the buffer values, we don't actually outperform. But once we go beyond the 44-day simple moving average with a buffer of 14.5%, it does outperform buying and holding. Now, the problem with this is it's still a very marginal outperformance. And we are almost picking now and potentially over-optimizing our back test, right? It's very unlikely that in the future, this exact simple moving average is going to work that well. It's also unlikely that this exact buffer will work perfectly in the future. So that's the problem with this result here, right? I'm completely straightforward with this. For most cryptocurrencies, trading according to moving averages works. For Gala, it does not seem to be the case. 7,000% per annum is buying and holding. Optimizing two variables gets us slightly above this. But if we are really realistic, this kind of a setup is unlikely to work as well in the future. So maybe we have to become a bit more fancy here. So what I've done as a next point, I've checked how would betting on falling prices actually work. So if we were to bet on a declining Gala price over here, could we then make money? So let's ignore all the positive price action, right? Of course, over the long term, Gala appreciates, but maybe we can at least make money when it drops by using such a strategy. Now, as a leverage, I have assumed we simply have factor 1 consistently, which is not that easy to set up because your leverage changes once you open a short position with most instruments. So that's something for another day. But let's straight again go into the results. So on the x-axis this time here at the top, we've got the moving average duration. And on the y-axis, we've got the annualized return when we short whenever the price is below the simple moving average without buffer. So none of those moving averages outperformed simply holding cash. So let's look again here at this 44 simple moving average duration. That's how this looks like, right? So we do make money when the prices consistently decline, but Gala tends to shoot up very quickly. It shoots up so quickly that our bet on falling prices rapidly loses. And so doing this, trying to get money when Gala depreciates, seems to have not been a positive, seems to have not been a profit-making strategy. Now again, this is zero buffer. Once we add our buffer, right, the 14.5%, this does look slightly better, but still, right, we start out with 10K US. We sometimes wiggle above that number, sometimes we are below, but in the grand scheme of things, this is our return, which is, if you're wondering, 8% per annum. But given all of this risk that you're taking, I don't think that's worth it. You might also have to pay quite a bit of fees when betting on falling prices. So that always depends on where you set this up and how the demand and supply for borrowing Gala tokens is. But still, using any kind of moving average, at least the daily moving averages from 1 to 52 days, it is a stretch for timing the Gala token. It does not work. You better get another cryptocurrency for active trading, or you take a completely different approach, right? You don't use moving averages. Right now, with this data here, it does look like buying and holding simply beats all of this. But what's definitely noteworthy is that for a lot of other backtests, this actually does work quite well. So I've done various backtests. I do one almost every single day. So if you're interested to get a backtest on your favorite altcoin, feel free to request this here in the Bitcoin Strategy Premium chat. As a premium member, you can also download the Excel sheet to this backtest, right? You can change the trading fees, you can change your capital, the moving average durations, the buffer. So you can download this over here in the statistics library of the premium membership. Various Excel sheets together with tutorial videos, exclusive videos that show how those backtests are being built or how you could potentially update them yourself. So that's the current deal on the premium membership. The link is in the video description, by the way. The price is slightly lower now because we are in a bear market. Money isn't flowing around that easily. If you decide though to register for an entire year, you do get 2 months for free. Of course, I will continue to publish free videos, so don't forget to subscribe. There's a new video on this channel every single day. Last but not least, you definitely want to watch the Gala video discussing tokenomics. It has gotten quite a bit of traction. There's even been a reaction video on this, so don't miss that out. You definitely want to watch the Gala tokenomics video. See you in that video. Bye bye.